Okay, ladies and gentlemen, welcome to Macro Ace with your host, Tony. We're going to be going through, of course, Nonfarm Payrolls. Hopefully you guys can all hear me clearly and you can also see the screen clearly. Do let me know if you do have any issues with the stream, and I'll try to reconfigure it or make it better or fix whatever the issue may be. But I've got my Choco milk here, Chocomel milkshake here. It's nice, a nice hot day here. UK, everything is all fine. We get some nice weather, but non-farm payrolls. So we've got we do have quite a bit to kind of get through with sentiment and what the release is. So let's get right into it. Okay, so what is non-farm payroll? So it is the net amount of jobs created in the prior month. Okay, and the survey is made up of the release has two surveys that make up the report. So you have the household survey, which represents the unemployment rate, or that's where the unemployment rate is derived from. And then you have the establishment survey, where around 440,000 different businesses around America are questioned and surveyed about how many people they have on their payrolls or how many jobs were created. So that's just in the simplest way to understand what the non-farm payrolls release is and what makes up the report for it. So the household survey, you do get about 60% of people responding back or taking the survey. And however, the only issue is as to why the unemployment rate isn't the more important release is that the establishment survey is more reliable, as of course these businesses have figures as to how many people they have on their payrolls, who they've let go, whereas household survey is asking your everyday person as to whether or not they're employed, part-time or full-time. And some people might be in a situation where they might be in employment, but it might not be full-time or part-time. So again, the establishment survey is seen as a more important part of the release, and that's where the non-farm payrolls figure is derived from. Then if we're looking at how it affects the markets in normal conditions, when there isn't big swings in sentiment or change in sentiment or central bank tightening or easing. So one thing we've got to consider is for the currency. Usually when the non-farm payrolls figure is really strong, or the employment data overall is very, very strong and shows that the economy or the labor market is picking up some steam, then that can be very positive for the currency, okay, in normal circumstances. Of course, we have a different circumstance. We're in a tightening cycle, but even in this tightening cycle with the currency, when we have seen in the past positive or a strong labor report or non-farm payrolls report, then the currency or the dollar has seen an appreciation generally. And then for stocks, this is where it gets a bit more tricky. So for stocks, usually what can happen is when we're not within the current tightening cycle that we're in with the Federal Reserve, if there is a healthy pickup in jobs, that can bode well for stocks. Of course, when there are more jobs created and there are more people and there are more people coming back into the workforce, then that will lead to higher spending or more spending that those consumers who would have been left out if they didn't have a job during a recessionary period, but coming back into it, they're able to spend a bit more money, go from goods to luxury goods or the staple goods to luxury goods, and also services as well. So you also see that in the CPI reports and also consumer confidence reports as well, is that a lot of consumers now are moving towards the service side of the economy and are looking less at goods, or there's less buying of goods compared to going into buying a service or using a service. So for stocks, generally, a good, strong labor report can bode well for stocks. But in this current tightening cycle, one thing we have to understand, the sentiment, which we'll go in a bit more detail, is that when the central bank is looking to tighten monetary policy, they will be looking at these pressures within the economy, such as in the jobs market, and also inflation, how that's faring to, and what is the current sentiment of consumers, and how and what happen if they raise rates, how will that affect it. So usually when you get a strong report, that bodes well more so for currency, because that will lead to potential tightening of monetary policy, or plays into the hand of a central bank to tighten monetary policy further, take stronger action. Okay, so that's the current situation that we're in right now, where we have seen in the past when payroll figures, the non-farm payrolls figure has come out, and we've seen weakening on the likes of the S&P 500 and NASDAQ. And then if we go on to bonds, so bonds is a very interesting point too. Now we've got to consider in a normal scenario, okay, usually when when the economy is doing well and everything is and people are trading risk assets such as stocks or corporate bonds or more exotic currencies or commodity-based currencies. For bonds, seeing a healthy pickup in the economy, right, means that there's going to be less appetite for bonds. Okay, and what will happen is that the government will increase the yield and decrease the price to try and attract investors and traders to jump on and invest in government debt. It's also similar in the tightening cycle too, and we've seen that recently with how the markets have been playing within the bond market, particularly when we had the news today as well that traders are expecting the ECB to hike by 50 basis points, and they're pricing that in. And we've seen the German 10-year bond see an appreciation or rise further off of the back of that. Again, when interest rates are raised, or there's a possibility of rates being raised, you've got to understand is that central banks control the short-term rates. Okay, when short-term rates are raised, also what that translates to is that the longer-term rates also see an appreciation as well. So that's one thing we've got to consider, is that with bond prices, with a really strong jobs report, you can see a negative move. You can see an appreciation, in bond prices, and a depreciation in bond yields. And then, of course, vice versa. When the economy is not doing so well, then you see the flip, where you see bond prices. When the economy is not doing well, what you can also see is that bond prices can at that point still rise further, and bond yields will head lower. So I think so that's within the tightening cycle. Now, outside of the tightening cycle, okay, when the economy is on its normal trend or growth path, bond prices, as I already mentioned with stocks, is that bond prices can head lower if you get a really strong jobs report. And on the flip side, if you have strong weak jobs data, then you see bond prices seeing an appreciation and bond yields seeing depreciation, as traders will flock to go into risk off mode and jump into bonds to try and keep their money safe away from the hectic markets where the economy might be crumbling or on the cusp of a recession. So if we go further, then hopefully that made sense. So the bonds are a bit trickier to understand, the relationship between how they perform in the past when the tighter cycle and also an easing cycle as well. But hopefully, if that didn't make sense, I will try and explain that for you a bit better again later on, or maybe after the video, or maybe during it. But so if we're carrying on then, so the indicators that are weighing on sentiment, okay, the key things to be aware of are where the economy is at the moment. So you have CPI at 8.3% versus 8.5%. Although there was a slight depreciation or dampening in inflationary pressures, we're still around 40-year highs, okay, with inflation in the US. And then with the PC price index at 6.3% versus 6.6%. So again, the PC price index year on year is one of the key measures of inflation that the Federal Reserve looks at. Okay? They don't look at the CPI index because the CPI is fixed. It has a fixed basket that it measures of goods, whereas the PC price index can kind of chop and change what you want to look at to kind of get a true sense of where inflation is at the moment. So with the Federal Reserve, that's their key indicator to see where inflation is at the moment, and that had also seen a decline as well in the recent report. The core PC price index, again, another key report for the Federal Reserve, had also seen a decline. It came in at 4.9% versus 5.2%. And GDP data, so when GDP was rubbish, it was at minus 1.4% for the first quarter versus 6.9%. And the second estimate data that we'd received last week, what we'd seen is that second estimate data had showed that GDP was at minus 1.5%. So still quite bad or worse than the previous, than the prelim report for GDP. And again, something to kind of just bear in mind when we're thinking about what the Federal Reserve is going to do in regards to their taking actions to try and control the economy as best as they can. Then if we look at the unemployment rate, that's 0.1% above the pre-pandemic level at 3.6%. So the pre-pandemic level being 3.5%. And the last report, the unemployment rate remained unchanged at 3.6%. So again, that also weighed on sentiment too, overall for how the markets traded. The US ISM Manufacturing Employment Index, which is what we had this week, showed that there was a decline to 49.6 from 50.9. Now, usually anything above 50, so for the headline figure or the manufacturing index itself, anything above 50 shows expansion and anything below 50 shows contraction. So you can kind of take that thought in the same way when we're looking at the employment index, that actually there might be a slowdown in employment within the manufacturing sector. Okay, so again, something else that to be aware of and to bear in mind when considering non-farm payrolls released today. Initial jobs claims this week showed a decline to 200k versus 210k versus the prior week. US job openings showed 11.549 million versus 11.22 million. And US employment costs, which we'd received nearly a month ago now, showed that employment costs had picked up at 1.4% versus 1%. And then ADP, what we had received this week or yesterday, will show that data or the jobs in the private sector, there was 120,000 jobs created versus 247,000 previously. Now, the forecast was 300k. And we will look into the reaction and how the markets took that figure. But the dollar itself didn't take to it quite well. You'd seen a depreciation, and the S&P 500 had seen an appreciation off the back of that. And as I said, we'll go into a bit more detail as to why that had occurred. So the triggers then. So according to economists and what they're looking for, so for non-farm payrolls, they're looking for a high estimate of 450k. Of course, remember today's forecast from the median estimate is 318k. So looking for about 142 deviation. Okay, so the high estimate, the actual figure of what they're looking for, or the high end is 450k. The low estimate is what they see is at 220k. So around 140k either way is what, on 100k on the low end is what the economists are looking for as a deviation for the high estimate and low estimate. US unemployment rates, so they see a high estimate of 3.7% with a low of 3.4%. Average hourly earnings, I think this is one thing I'm going to go into a bit more detail of, which is very important to understand as to what caused the depreciation in the dollar, even though we had a strong figure or a positive figure with non-farm payrolls. So average hourly earnings are 5.5% versus, so seeing a high estimate of 5.5% with a low of 5.1%. Private payrolls, high estimate of 388k with a low of 200k. And then if we're looking at an investment bank views, then where do they see non-farm payrolls figure coming in, or the unemployment rate? So all of them, also the majority of these investment banks, or the ones that I've seen, they're all looking for the unemployment rate to tick down from 3.6% to 3.5%. That sentiment isn't changed. So the last month when I did the non-farm payrolls release prep, the majority of economists and investment banks were looking for a tick down to 3.5%. So TD Securities sees non-farm figure coming in at 300k. Bank of America sees it coming in at 375, as does, and then Deutsche Bank sees 325k. So, as said, median forecast from economists is seen at 318k, but all of these investment banks are expecting a tick down in the non-farm payrolls figure compared to the prior figure. Okay, remember the prior figure for the release is 428k. Then the previous report. So the payrolls number showed that demand for jobs is still very hot, and employment gains were led by leisure and hospitality, manufacturing, transportation, and warehousing. So a lot of the jobs had come from the services side of the economy. And I think one thing as to why they said the payroll number shows that demand for jobs is still very hot is that the figure itself, if anything above 400k, shows that the economy is in an expansionary phase and the economy is picking up some steam. Okay, so that's one thing we've got to bear in mind is when we're looking at from an economist's point of view, that 400k shows that it's there's a decent pickup in the employment sector, or the employment part of the economy. LA Trading says, I think the dollar is going to lose traction today. Okay. Right, so S&P 500 and the Fed's balance sheet. So this is quite interesting just to bear in mind, is that as you've had, just to put things into perspective then from the start of COVID towards near enough our end now, we've had, so when the Federal Reserve had jumped in and increased their balance sheet, i.e. buying of government securities, corporate bonds, and opening up these different facilities to allow these companies to borrow money from the Federal Reserve, particularly the big dogs, the big companies, right? You'd seen that as the Fed balance sheet had skyrocketed, so did the recovery in the S&P 500. Okay, so what I'm trying to say here is that when the Federal Reserve was providing support to the economy, the stock market loved it, right? They lapped it all up, right? That sentiment had driven the market to another big all-time high at around, or near enough 5,000. On there's a little infographic shows from Bloomberg, and the Fed reached its peak of around 8.9 trillion on its balance sheet. So there's a lot of money being chucked in to the economy. Now, of course, that's been reduced, and you've had the rate decisions that have come in, and the expectation for further rate decisions, and the removal of that support. Okay, so if that's because the economy, in the Fed's view, is doing well enough to be able to withstand rate hikes and tighter monetary policy. So with these jobs reports that we get and inflation readings, when the jobs reports are quite strong, that plays into the hand of the Federal Reserve to tighten monetary policy further and to take quicker action to tighten monetary policy. So that's just one thing I wanted to note and highlight to you guys as to why it's important to bear in mind where the economy is as a whole and what the Federal Reserve is doing and how that's impacted the market so far. So if we're looking at the ADP employment, then so the ADP employment, it's private employment data that is released, not from the government, but it's released. But it's something that traders do have a focus on. And the reason why they have a focus on ADP employment is that it can, to a degree, foreshadow what the employment or the non-farm payrolls employment figure could be like. When I say that, What I'm talking about is which direction will the actual employment figure go? Will we see a pickup in employment, or will we see a downtrend in employment, right? Or the number of jobs being created. So the ADP employment figure, although it is used as a way to forecast what the non-farm payrolls figure could be, it hasn't had a very strong correlation, or a strong correlation in enough to say, yep, if ADP comes in to if it shows that more jobs were created, then non-farm payrolls is going to be the same. That's not the case, right? It's useful to kind of keep an eye on anyways to see what the employment situation is like. But the reason why there isn't such a strong correlation, if that's your question, is that ADP employment measures private payrolls in the urban areas, okay, and uses and looks and surveys the big businesses. The non-farm payrolls figure itself from the government goes to the rural areas and surveys big businesses and small businesses as well. So you get a truer sense of where the employment situation is with the non-farm payrolls figure compared to the ADP employment figure itself when that comes out. So private payrolls increased, as said, by 120,000 in May, which is the lowest gain of the pandemic era recovery since April 2020, according to ADP. And that leisure and hospitality sector were the most hit by restrictions, which had been a leader throughout the recovery. And they saw new highs of just 17,000. Again, in the private sector for the large businesses. So, according to Richardson, so what she says, chief economist, is that under a backdrop of tight labor market and elevated inflation, monthly job gains are closer to their pre-pandemic levels, right? The economy is near enough back to normal. And the job growth rate of hiring has tempered across all industries, while small businesses remain a source of concern as they struggle to keep up with larger firms that have been booming as of late. So you've got to consider this tight labor market that has been created, where these smaller businesses, if these larger businesses are taking a majority of the labor force, the smaller businesses will have to raise their wages, right, to try and attract the workers to their company. And in turn, that adds to inflationary pressures where CPI starts to go higher because people are being paid more, and there may be less goods available in the economy. So that drives up demand compared to supply, which might be dwindling. So this is one thing just to understand, is that with the ADP, although yes, as said, can be useful, doesn't always have a strong correlation with the non-farm payrolls figure itself, as it doesn't give a true sense of what the employment situation is like for small businesses and in other rural areas too. So as said, figure came in 128k, forecast was 300k. So the S&P 500 had strengthened and the Dixie had weakened. So let's have a look at the charts then. So after the data, the dollar had dipped and the S&P had strengthened. The reason being is that one, with the with ADP employment figure, you don't get the inflationary measure, or such as the average earnings year on year, okay, or month on month. So that was away from the report, okay. And then because the figure was really bad, that meant that to traders in their mind, that they thought, okay, the figure is really bad, then the Federal Reserve might not be so strong in their monetary policy action. Okay, one of the talks is that could the Federal Reserve pause at some point with their monetary policy if the economy has near enough reached its peak, okay, or if the economy is still strong and inflationary pressures aren't going down, and the employment situation and the labor market gets even tighter, where there are a lot of jobs available but not enough workers, so there's a need to raise wages to try and attract those workers, then could that mean that the Federal Reserve doesn't decide to pause their rate hiking cycle after they've reached their neutral rate, and instead start hiking even further, which plays negatively for the stock market? Okay, so one thing to consider is whenever interest rates are raised, stocks don't see an appreciation in the markets, they see a depreciation because it increased borrowing costs. Whereas for the dollar, it makes it more attractive as an investment because it's worth more. Okay, so with the S&P, so I think the reason why I'm showing you this chart is that I think with the release that we have today, if we do get really strong non-farm payrolls figure, usually we look for around a 300k deviation on the headline figure. Just that itself. Of course, there are other releases that we have to be aware of, but then what that could mean is that if we do get a really good figure or a really strong figure towards the upside, then the dollar could see an appreciation and the S&P 500 could see depreciation. And then vice versa, if we get a really weak figure, then we could see similar reaction as we had seen with ADP employment, right? Like I said, traders trade it as a way to kind of forecast or get a sense of foreshadowing as to what the non-farm payrolls figure could be or how it could react positively or negatively. But I think this kind of shows that as I said, if we do get a negative or positive, we may not get a whipsaw reaction like we did last time with the non-farm payrolls release. So Fed views then. May 17th, Powell, there could be some economic pain involved to get inflation down. There is a real possibility that globalization will go into reverse to some extent, and we need to push ahead with rate hikes. So that's something that everyone knows and understands. But the only thing is that when he said that there could be some economic pain involved, that means jobs, right? Higher the interest rate, the less amount of spending that businesses are able to do to create those jobs or to be able to pay their employees, then it makes it harder for them to be able to do that. And then also in regards to like recessionary talks, which everyone's fearing at the moment, Powell said that we will have to slow growth to achieve a softish landing. So yes, there's going to be somewhat of a downturn, but Powell's goal is to try and make that as soft as possible. Bullard said that some businesses are going to get punched in the face as consumers substitute basic necessities for luxuries. Again, as I said, when consumers are in a buying mode or in spending mode, they'll go more towards luxuries, and that's what Bullard has said there. But he doesn't see a recession this year or next, and it's not in his base case. That's not what he's expecting to happen this year or next year. But he hasn't said if it is going to happen or not. And the Fed minutes from the May meeting, all Fed participants agreed that the US economy was very strong and the labor market was extremely tight and inflation was very high, always very high. Views and sentiment then, so you have other points of view to understand then, is that inflation, we had, has it peaked with the negative CPI figures that we had received the last round, and also with the PC price index too. So slowing for the second time was what we had seen with the inflation data. The S&P 500 was on its way to end 7 weeks of losses, okay, or about 800-point depreciation on the S&P 500. Bank of America say that global equity inflows saw their biggest inflows in 10 weeks, led by US shares. Morgan Stanley and Bank of America say that more losses could be ahead, and BlackRock cut developed market shares to neutral. City strategists recommend stepping back into stocks, particularly in Europe and in emerging markets, on their appealing valuations. So, although yes, you did see the S&P die for about 7 weeks, these investment banks are saying that actually maybe the economy would be able to withstand these rate hike decisions and the tighter monetary policy. And we may get a soft landing instead. So that could bode well for the stock market instead. But as I said, we can't look at one figure, right? We can't just look at the headline figure, non-farm payrolls itself. We've got to understand, so the previous market reaction, okay, the reason why we had seen a depreciation on the dollar and an appreciation in the stock indexes on the S&P 500 and the Nasdaq is because, one, markets were and economists were expecting the unemployment rate to tick down to 3.5%. We didn't get that. It remained unchanged. And the average earnings year on year was lower than expected. Okay. So if I just bring that up here for you. So the previous figure, right, was 5.6%, and the actual figure came out at 5.5%. So for traders and economists, they're thinking, okay, the inflationary pressure from average earnings year on year is shown to see some reprieve or some easing or some dampening. To that end, if I show you the deviations, or if this was a market reaction, okay, just a quick snapshot of it, you'd seen the S&P 500 shoot up, the dollar shoot down, and U.S. government 10-year yields had also seen a decline. Had seen a decline as well. Gold had seen an appreciation, but you can see that it wasn't a straightforward release to kind of trade. It was very mixed. Where there was a lot of whipsawing that had occurred within the first 5 minutes of the release. So I think one thing we need to highlight is that the key focus for traders at the moment is, and what we've seen with past releases with the CPI and the PCE price index, is when we see that inflationary pressures are dampening or starting to peak or actually starting to see a decline, that's positive for the stock market, right? It means that the Federal Reserve might not be as aggressive with their monetary policy tightening or their rate hiking cycle. And then there might be a pause at some point, and they won't need to take any further action to try and dampen inflationary pressures. So that's how the market takes inflationary data readings. And I think the average earnings year on year is going to be quite, and also the month on month too, is going to be quite key to understanding as to why the dollar had seen its dip off of the release. Okay, so that's one reason, or that's two reasons, should I say, as to why we'd seen the dollar see a decline rather than appreciation. The other reason, okay, if I bring up the deviations here for you, right? So from the last release that we had with Nonfarm Payrolls, is that the deviation, there's only a 48k deviation from the forecast figure to the actual figure. So in the past, what we've been looking at, or what we've been looking for, is around a 300k deviation, right? Enough for it to kind of take precedence over some of the other releases. And then maybe enough for the dollar to see an actual appreciation rather than a tick down. So again, as an example, 4th of Feb, before the Russia-Ukraine invasion, so you'd seen about 58 ticks down when there was at least 300k deviation there, or at least 250 to 300k deviation. So 58 ticks down on the S&P as the 31 pip move towards the upside on the dollar yen. And then the next release, what we'd seen is that there was 265,000 jobs. This point here, again, this is slightly different. There was other business sentiment that was affecting 4th of March here, where actually the release didn't kind of go in the way markets were pricing in, or had priced in the release, and the release happened, and then the markets ignored the rest of the release and kind of carried on the way they were moving. But here we go. So when non-farm payrolls figure had seen about a 48k deviation, and also the average earnings year on year, or the inflationary pressure in the wages area, had seen some dampening or some tempering. We've seen appreciation in the stock market and a depreciation in the currency pairs. So you can see here, dollar yen had seen about 22 pips towards the downside. Euro dollar about 25 pips up. GBP USD or cable about 33.5 pips up. So that was the biggest mover currency-wise that we had seen with the last non-farm payrolls report. So I think that's going to be quite key to just have a watch of and see how cable reacts. but we had seen that cable was the strongest had seen the strongest reaction pip wise in the markets. For the dollar CAD, again 20 pips down. Aussie dollar, so we've seen about 24 pips up. New Zealand dollar had seen about 22 pips up. We've got about 10 minutes before the release. Got to keep an eye on that timer. Gold had seen about 41 ticks towards the upside. And then two-year bonds, bond prices, and 30-year bond prices, what we'd seen is that we'd seen about 23 ticks up, and the 30-year had seen about 5 ticks up. Okay, so and of course with the Nasdaq, we've seen about 350 ticks towards the upside. Now these figures and brackets represents the movement 10 minutes after the release. Okay, so it was about, so on the initial candle we'd seen about 88 ticks towards the upside, and after 10 minutes the S&P was up by 59 ticks from the initial candle. Okay, and the NQ, or the Nasdaq, was up by about 233 ticks. Dollar yen was up about was down about 3.5 pips. Euro dollar was down was up about by 11 pips. GBP or cable was up about by 16.8 or 17 pips up. And dollar CAD, you're saying a lot of things. Just waiting for the NFP to pass. Make more videos like this, risk on, risk off. It was quite helpful. Yes, there is going to be another webinar. It's either going to be on trading economic events, or it's going to be about market correlations. I think the market correlations is going to be the one that's going to be shorter, but yes, there will be more videos in the future. So let's get our expectations kind of set of what we should expect then. Now, of course, as I said, inflationary pressures are quite key to the markets. See if we've seen our peak, or we're seeing a dampening of that mood. So the average earnings year on year, I think what we look for is for that to see a turn or tick down. Okay, if we're expecting the stocks to see a positive reaction, but we'd also expect we wouldn't, if we're trading the stock market, I don't think we'd want a 300k deviation on the headline figure. Okay, we would want something similar to this, right, where there isn't too much of a deviation in the figures in a positive direction for the economy. So more or less, you're looking for, in a way, the economy, the non-farm payrolls figure to be a bad one to a degree from what we've seen last time, or not an outstanding one. Again, like we'd seen, there was more of a mixed reaction in the markets when the figures weren't outstanding. So but for the dollar, if you're trading currencies or the dollar, I think in the past you look for about you'd want about 300k deviation on the non-farm payrolls figure itself, and you'd also want the unemployment rate to actually tick down, okay, or to meet the expectation of economists. Okay, private payrolls too, you'd also, as said, you'd want that to show a strong figure of at least around 100k, okay, or at least 100k private jobs added to the economy. And then if you're again, for the bond market, it's going to be quite interesting to kind of see how that plays and what happens. But I think what we want to understand is that if we do get a really strong figure from the non-farm payrolls, then you'd expect the yield, or the bond yields, okay, not the bond price, you'd expect the bond yield to see an uptick, and bond prices to see a movement towards the downside instead. So that actually should show you. But yes, so you that's one thing you should expect. Okay. What else? Again, that's one possible scenario of what could happen. What else are we expecting? So gold, anything, again, if it's more or less if it's not interesting or if the data's not outstanding, you'll probably get similar reaction as we'd seen here. But more so, I think the focus was that the average hourly earnings year on year was in line with forecast and was lower than the previous figure, and then the unemployment rate didn't go down either. So I think for gold, if you're keeping an eye on that, you're of course the headline figure itself, but these two, the unemployment rate and the average earnings year on year, are going to be quite important for you to kind of keep an eye out for. All right, as Zach Galifianakis would say in his Between Two Ferns, if you've seen that, I don't know if you have. We've got about 4 minutes. It's probably one more thing. Oh yes, and of course the previous market reaction. Okay, so about 10 seconds before the release, we've got a dollar yen, and we've got the S&P and dollar CAD. Of course, we had the Canadian employment change at the same time. So the Nonfarm Payrolls figure came in, it was a 48k deviation. We've seen that average earnings year on year was lower than forecasted. What else we got here? So you see there, so the S&P 500, although yes, you had the headline figure itself, which was an outstanding, didn't meet the 300k deviation that we usually look for, or between 250k to 300k deviation on the headline figure itself, and the unemployment rate didn't tick down. And average earnings year on year had also had seen a tick down, showing that inflationary pressures are becoming tempered. So that was the reaction there. Let me get Tick Strike open just so I'm ready with it. Yeah, so if I keep going on a little bit more, you see that the markets were quite choppy. Okay, so because the data wasn't outstanding or that great, the currency pair is a bit choppy. It wasn't like a straight shoot towards the upside or downside. It kind of reversed a little bit and then tried to find its route. We go ahead forward. Okay, so whoops. There we are. Let's go back. Okay. So more or less, the reaction was quite short-lived, if we're putting it that way, for the S&P and also the dollar yen. All right, we got 2 minutes. Let me get my screen set up. I think we did get some comments. Whoops. Right, let's move that out of the way. Get my financial use website ready. Also want to get my Tick Strike going too. All right. Go. Let's get that. Things we can get it. And let's get Tick Strike in here. Probably missed out some of the other. Whoops. Okay. Side there. There we go. Okay. All right. So I've got the 10-year bond price here on the bottom left-hand side, the S&P 500. We've got gold, and we've got the dollar yen. I will have a look at the GBP USD or I will have a look at cable. Of course, that was the biggest mover the last time around that we had the data that come out, or when the data had come out, and we'll have a look at that, see if it is still the biggest mover compared to the other currency pairs. But right. Minimize that. Get that out of the way. Right, got about 13 seconds. 10 seconds now. All right, 3.6%. So unemployment rate remains unchanged. Non-farm payrolls 390k, higher than the forecast of 318k. Average earnings year on year at 5.2%, in line with the forecast of 5.2%. US private payrolls showing 333k, higher than the forecast of 301k. Average workweek hours 34.6, in line with the forecast of 34.6. Average earnings month on month ticked lower by percent to 0.3% compared to the forecast of 0.4%, unchanged from the prior figure though. Manufacturing payrolls 18k, lower than the forecast of 39k. What else we got? Participation rate, or that was unchanged from the forecast, but slightly higher compared to the previous. All right, so the markets, so the dollar yen seeing an appreciation here. Bond prices has seen a depreciation, so that would in turn mean that the yield is higher. The S&P 500 ticking higher here as well. I think the only reason why that's one of the reasons why that's ticking higher is, again, you have the average earnings, which was lower than the previous figure and in line with the forecast figure. So there was 380k there. Bring up, where did my other stuff go? Bring it up. All right. 390k. Forecast 318k. So there was about a 72k deviation on the non-farm payrolls figure itself. The unemployment rate remaining unchanged at 3.6%. Private payrolls, seen, as said, actual figure 333k. Okay. And then the forecast 301k. So there's a 32k deviation there. And average hourly earnings 5.2%, so it's unchanged. Okay. So non-farm payrolls have seen about 70k deviation. Unemployment rate remained low, remained unchanged. This is quite a. So yeah, we did get the movement there, that little that pop up on the dolly end. Let's have a look at the gold. That's gold. Okay, so gold had seen a bit of a movement towards the downside there. Then let's move it back towards the upside. Let's bring up. So keep the government bonds there. Let's see what happens. GBP USD. That was the biggest move last time. Oops. Okay. Oh gosh, that is not nice. Did see a movement towards the downside there. All right, let's zoom in. See what we got. What are we playing with? Kind of see that. So it's about 17.5 pips down there. If I just bring up the dollar yen. See what we're dealing with here. Okay, so it's about 22.5 pips up. And the S&P, I'd also seen some movement towards the upside. That was quite nice. All right, and that was about 100. Okay, right. Cool. Let's take a look at gold. Okay. Okay, so let's talk with the other currency pairs too. Dollar. Eesh. Okay, I'll move the downside movement first. See what happened there. Okay, so about 14.5 pips down there, but then the candle finished up. It was about five pips up. Actually, it's probably more. Get it right. No, okay, there's about five pips up there. Let's look at AUD USD. Similar reaction. So at the moment, the dollar yen was the biggest mover, whereas last time I said it was cable. Okay, so it's about 11.4 pips, or 11.5 pips down on the initial reaction, and then probably it's about 3 pips. Yeah, 3 pips up. New Zealand dollar, USD. About 10.5 down. What else do we want to look at? Let's also look at the T1. Right. Oops. Let's bring up the dollar yen back. Right, so the dollar yen is still moving higher off of that release there. If we're looking at, let me look back to those triggers then. So remember the high estimate that economists were looking for non-farm payrolls was 450k. So about 60k off for the high estimate there from the economist's point of view. The unemployment rates, of course, stayed unchanged. The high estimate was 3.7%. Average earnings year on year, it's seen a high estimate of 5.5, but the low estimate of 5.1. So more or less close to that. And private payrolls had a high estimate of 388k. So then this kind of changes the game a little bit. It makes it a bit harder to kind of decipher the figure itself. But I think from what we can see here, that even though we had about a 72 or 70k deviation, the dollar yen, and we had like a mix of data, right, where it wasn't really outstanding. Even then, the dollar yen had seen a positive move compared to all the other currency pairs. Though the dollar yen has seen the nicest move from what we can see. So again, 2p USD. Yeah. So if you're trying to trade that initial candle, and then you think, oh, it's gonna go back, then that would have been quite horrible to kind of trade that. The dollar yen had a nice move, as said. Gold, yeah, it's more of a. It's the S&P 500. Let's have a look at the NQ on the Nasdaq. It's a delay. Similar reaction on the NQ there as well. Okay, right. USD. Oops, that's the wrong one. Right, let's go back to your questions now. Whew, okay, right. So active Imelda, I've said your name right there. I think Aussie dollar will reset and go up. Should NFP be weaker and NZ dollar downward and NZD USD downward for a positive NFP data? Is there an indicator you can use to predict NFPs? No. If there was an indicator to predict what the NFP figure could be, like spot on, right? Then I wouldn't be here to macro ace. I think everyone would want to jump on that. I think if you're talking about economic release wise, you could have to, it's really difficult. You'd have to really delve deep into all the economic indicators and understand where the economy is headed to kind of gauge which direction non-farm payrolls could go in. But to predict numbers, no. That's if you can do that, FX Burrs, then heck yeah. Then come on, let's make some money. But yeah, there isn't anything you can do to predict non-farm payrolls numbers itself. Similaria says, do you also have opinion about Nasdaq? It is actually good to have high non-farm payrolls in the forecast. I think the key thing is, as I said beforehand, with non-farm payrolls figure, is you have the other bits of data too. So unemployment rate remain unchanged, and the inflationary pressure of wage prices, pressures. Jeez, I'm going Sean Connery. So if we're looking at the average earnings year on year, the average earnings year on year tick lower. Okay. I think that was one of the key things that moved the stock indexes in the positive direction that it had seen. Now you're seeing some the reversal of that trade was the dollar yen is going higher. It is dollar yen is flying after that bit of data still. But I think, as I said, inflationary pressures are the key things to kind of keep an eye on for non-farm. You could be right. And actually saying that with the employment data, that now that the economy is is growing at a robust pace, the Federal Reserve has their expected rate hikes. But one thing I was looking out for, and I think I'll be looking out for in the future, is does the Fed's narrative change if we continue to get strong figures from non-farm payrolls and the labor market becomes tighter? That's one thing I'll be looking out for, whether they say maybe a neutral rate of 2.4% isn't enough and we need to get 3% like Fed's Bullard had said yesterday, and then see what happens after that and how the economy reacts. All right. So now you have seen me use financial juice. If you listen to the feed, or if you keep an eye on the headlines that come through, you will know that having a live voice and text feed or a Squawk service is very key. Okay, no need to managing your risk with the markets, with the economic releases that are happening. So if you were unsure as to why the dollar yen had moved up, or the S&P 500 had moved up, then you can look at the data in real time to the second, right, when the data comes out, as to why the markets would have reacted in a certain way, or why there's a pickup in volatility. Let's put it that way. Okay. Now, having a live voice and text feed. Okay, so investment banks use a live voice and text feed to manage their risk. That's what I've seen a lot of traders do and talk about to me as to how they use a Squawk service. That's the main method. Of course, there are different ways to kind of use a Squawk service, but managing risk as to what's going on within the markets and why markets are moving in a certain direction it's key to have, and that's why investment banks use it, and all the big players, right? They will use it to listen out to what's going on fundamentally. Fundamental news is key, and that's what drives the markets most of the time, right? Of course, you have your technical areas where the market might be reaching a certain level of resistance or support, and maybe traders are looking to buy the dip or sell at the high point. But more or less, it is news that drives the markets in a certain direction. So if I just bring up an example for you as to why it's important to listen out for news, I'll just bring this up here. Okay, here we are. So we had a headline on May 31st where the Wall Street Journal had put out a piece headline, okay, that said that OPEC members were considering exempting Russia from oil production deal. I.e., what that means is that that the other nations would actually take over and try to alleviate the pressure from Russia by building more of their own inventories instead, to try and take the pressure away. But the markets didn't take that in a the WTI crude oil didn't take that in a positive way. If you've listened to my other live streams when talking about EIA inventories, when there's a build in inventories or when there is more oil being supplied to the markets, then you see a depreciation in the price of oil. So this is what happened. Okay, that news came out, and if you're unsure as to what was going on, like, what? Why is WTI crude oil going down? Okay, there we are. You have a headline, you have a reason, and we chart that data for you with the headline as well to the exact point that the headline had come out. Okay, and the headlines that we put out via voice and text is very, very quick. Okay, we try to be as quick as we can to make sure that you guys can manage your trading better. But that's one very big reason as to why you should use a Squawk service and why the big boys and the big players, I don't know why I did that. The big players, investment banks use a Squawk service. Okay, so that's one reason. And if you're on FJ Lite version, the big difference with the FJ Pro version and the FJ Lite version or the free version, okay? FJ Pro, you get no delays, no adverts, okay? Your economic releases appear in real time, and your economic triggers that you would set yourself here on the side. So if I was looking for, let's say, if I was looking for 300k deviation, if I was saying like 600k, and I wanted to put that down as my buy alert, and I saved it, ignore the figure here being, which is kind of shaded. That's just showing you the forecast figure. We're not telling you to put your trigger in as that figure. But if it did meet my trigger that I put in manually myself, then it will appear here with a buy or sell signal to, of course, and that's, again, as soon as the figure comes out, that's when the notification appears at the same time here on the side. So that is also real time too with FJ or Financial Juice Pro. Okay. So again, what we try and do is help you as much as we can from our side to give you the best information, quickest updates, and give you an understanding as to what's going on within the market. So if you don't know this already, or you haven't tried it out and you're stuck on the light version, you're thinking, well, I got to pay for the pro version, don't I? Well, not for 7 days. There's a 7-day free trial of Financial Juice Pro. That I've put the link in the chat for you that you can have a look at, have a play with it. Kind of, if it's the first time you're using a Squawk service, really try and delve into it as much as you can, okay? And really try and understand how it's used. And there's also a video to kind of give you an understanding as well of that. But definitely have a go at that 7-day free trial as well. And kind of get used to it. Even if you don't decide to take on or pay for a live service or real-time service, which is more beneficial, kind of manage your trading better. As said, there is a live version option available, but you have that slight disadvantage compared to someone who is able to see headlines and reactions in real time and translate those or connect those to the headlines and the voice that they hear or the headlines they see. Okay, so that's Financial Streets Pro. Now you've been seeing this beauty here at the bottom go off with Tick Strike. If you're not familiar with Tick Strike and you're not sure as to what it is, if I put it in the simplest way, let me bring it up. To put Tick Strike in the simplest way to understand it is it represents order flow. Okay, it represents how much momentum there is in certain asset classes or an asset. Okay, now Tick Strike will show you that information for a variety of different assets and areas. So you have your futures in gold, crude oil, and you've also got crypto that it shows as well, stocks, currency pairs, ETFs, ETNs. There is a lot of things that Tick Strike covers and different assets that Tick Strike covers, and is very useful can be useful to traders. Now, so let's explain Tick Strike then in a bit more detail. So imagine yourself that you're within the trading pit, okay, and you have all the guys and gals who are ready for the market to open, or maybe there's a big bit of news that's come out in the markets or on the wires, and they all start shouting, buy, 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 sell, 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 buy 100 shares and blah, 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 and they go on and on and on. Tick Strike translates that momentum into a visual notification and an audio notification. At the moment, I have the sound off, but usually when there is some buying momentum, as we can currently see at the moment, it will give you more of a high-pitched tick sound. And when there is selling momentum going on, then it will give you a lower-pitched tick sound. Okay. Now, I've got my setting. The other thing about it is I've got my setting here on 1, right? So there are different levels that you can set Tick Strike at. Level 1 is when Tick Strike is the most sensitive to the asset or asset classes that you'd be looking at. Okay, and level 15 is where Tick Strike is the least sensitive to movements. So if you're a scalp trader and you're looking to kind of capitalize on the small movements here or there, maybe, and again, it depends on how you want to use Tick Strike. I'm not telling you this is the way you have to use it, but a lot of the time, some people what I've read in the past from customer reviews is that they've said, if they've put their ticker or the Tick Strike on to a more sensitive level, then they can kind of capitalize on where the markets are moving. So if you're looking for small bits of momentum, right, you would keep it at the level of 1 or the most sensitive. But if you're looking for big swings in momentum or big movements in momentum, you can up the ante and you can put it to the least sensitive setting. Of course, you can kind of chop and change how sensitive or you want that to be. But 15 being the least sensitive when you're looking for a lot of momentum in an asset or in different assets together, then only then will a Tick Strike go off. So at the moment you can see, of course, I've got mine. So you've got the NQ here on 1, and the S&P 500 I've just put on 15. Nothing's really moving at the moment now, or too much. Okay, so when there's a bit of buying momentum going on here, I've got my level at level 15. So only when there's a real amount of momentum going on, will that indicator or will that notification start to pop up for me. Okay, so that is Tick Strike that you can use, and we also, because we're so kind, so generous, why don't we give you guys a 7-day free trial of that? Okay? 7-day free trials of Tick Strike. Have a little play with it, kind of get used to it and gain an understanding of it. There's also a little tutorial video to kind of help you with understanding it. And then finally, before I leave you guys, is if you liked this video, Okay? Don't forget to like the video, share the video, subscribe to the channel so you can stay up to date with all the other videos that they'll be putting out via Macro Ace on the channel. But I think the key thing would be, of course, is to show your love and follow us on Twitter. So that's our Twitter, a link to our Twitter that you can use to follow us there. And of course, I'll be putting out the links to the live streams as well on there as well for you to look at the day before. But if you were kind of interested in the deviations that I was showing here, okay, or giving you a better understanding as to how the markets reacted previously to the other releases. Not only do I of course cover non-farm payrolls as the big dog release other than the Fed interest rate decision, but I look at all these other different releases, okay, for the US session, and I go into a lot of detail as to how these different assets. You're not sure if that's the right Twitter account. Yeah. From Macro Ace. Yes, it is. Should be. Oh my gosh. Oh no. You're right. That's interesting. It looks like somebody's trying to use me. Ooh. It's like somebody's tried to. Wow. Okay. Whoops. Let's put that one in there. Hold on. That's the right Twitter account. Let me remove that message, actually. There we go. That's the correct one. Looks like somebody likes... This looks like Macro Ace is becoming very popular. Enough for somebody to try and jump on it and use the name. But yes, apologies. If you did go to the other account, thank you, Nick TS, for making that correction there for me. But yes, as said, for looking at deviations and going into more detail about how the markets have reacted in the past to previous releases, and to kind of gauge what to expect, then the deviations is something that I provide to the subscribers to the mailing list that we have. Okay, so not only do I provide this so this is put out on a Sunday for the releases ahead of the week or for the following week. Not only do I provide you with the deviations for the upcoming releases, but also give you an insight as to what to expect for those releases and news-wise, what's been going on and going around, how that's affected the market to a degree. So that's also provided on Sunday as well, as part of the mailing list that people have access to. Of course, if you don't want me to kind of quickly rush through this, which is what I usually do, then you can have access to that every Sunday to be able to look at the deviations in more detail and gain a better understanding as to what to expect for the week ahead. Okay, does anyone have any questions? Are we all good? Did anyone? I know some of you said they were kind of waiting. Kurt B said just waiting for the NFP to pass. Okay, did anyone trade that release? Did anyone kind of lap it up and take a hit? Of course, I know non-farm payrolls can be very, very volatile trade. But if you guys did enjoy that, don't forget to give a like to the video and subscribe to the channel. Other than that, enjoy your weekend, enjoy your Friday. I will be putting together what I'll do today, if you're subscribing to the mailing list today, and I do this anyway, but I'll be putting the videos together of the non-farm payrolls video, and also the EIA inventories release that I did this week as well, and then any other releases that I covered. I'll be putting that in one email, okay, for you guys. Rather than doing one email a day, I think that's a bit too much. It's better to just put all the videos that have all the economic events that have occurred in the week, put it together one email for you to watch. So you'll be getting 2 emails per week, just so you kind of know what to expect. Other than that, thank you very much. Take care, and I will see you next time. Goodbye.